Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And with this video, I'm going to take a look at the power and protection of growth stocks. One of the questions I get asked quite often, and even comment, I guess you would say, is that, how do you value growth stocks compared to others? I always talk about using a normal price earnings ratio of 15, which is a earnings yield of 6.67%. When you're looking at names like Johnson & Johnson or General Mills, like we talked about yesterday, or any of these, what I would call normal, average, even slightly above average growth stocks, that's a pretty good benchmark for fair value. But with growth stocks, they're different. It has to do with the power of compounding and how fast they grow. With growth stocks, it's all about what the future earnings are going to be and how big they're going to get over time. And, with growth is all about compressing time. So let's take and review a compounding table here and look at what actually happens with different rates of growth. So I've got just a simple compounding table here, and I've highlighted it and I've color-coded it so you can see how powerful it is. Higher growth gives you quicker doubles, which is actually compressing time. And time is the key factor here. Understanding how much faster these companies grow over a period of time is really what the power of compounding and protection of compounding is all about. And it's all about why you can pay higher multiples to buy growth stocks and still make a great deal of money. In fact, if you really have a true growth stock, I'm going to also demonstrate here in this video, it's actually hard to overpay for one because you can pay even outlandish valuations for it. But because these companies grow so fast, you actually will end up making money. Now, the better valuation you pay to buy them, the more money you're going to make. I do want to make that clear. Valuation still matters. It's just a different kind of valuation. You're really valuing the future more. But I want to remind you of something else before I get too far along on this. One of the things that people forget, when you're dealing with high growth, and I'm going to cover the FANG stocks here, Facebook, Amazon, Netflix, and Google, currently, technically known as Alphabet today. And what I'm going to do here is I'm going to talk about these stocks in the context of their historical growth, but you got to really also pay attention to their future growth because that's what really matters. And I'm going to show you how powerful these stocks have really been by looking at these FANG stocks and how you can invest in them and make money even if you overpay for them. But obviously, we want to make the best purchase price we possibly can. If we can identify ways to value them, then that's going to help us make a great deal more money. Now, you can be more lenient with value here because of compounding, as I'll illustrate here in a moment. But, it's still something that you really need to pay attention to because the amount of money you make and the amount of risk you take is critically important. Because here's the thing. I want to remind you that, Home Depot ended up with Lowe's. McDonald's ended up with Burger King and 1,000 other companies. Walmart ended up actually with Target and then now with Amazon. So, when a company is making extraordinary amounts of money, generating extremely high margins and growing their business at, significantly fast rates, competition will come in. They say that, imitation is the ultimate form of flattery, and all these companies, no one will let someone have a market all to themselves, although that's been happening with some of these FANG stocks, Amazon and Facebook, and for that matter, Google, to name a few. Netflix, as I'll show you, is facing a little more. But let's just talk about compounding here a moment. I want you just to understand the magnitude of the numbers. So, the old rule of 72 comes into play here. If you grow money at 10% a year, it takes approximately 7.2 years for that money to double. So, I'm looking at just $1 invested here, and I'm going to talk about, what I'm talking about is the power of compounding. So if you invested in something that grew by 10% a year, this is what that we'll call it a dollar's worth of earnings would grow to over time. By year 7, 7.2 years, you'd be getting that double, turning $1 worth of earnings into $2. Now, if I ratchet that up to 15%, I'll skip all the others. The others, now it only takes 5 years to double my money. So that $1 worth of earnings growing at 15% will double by year 5. And if you've got a 25-year time frame, there's a big difference between it doubling every 7 years versus doubling every 5 years. Now, ratchet that up to 20%, and now your money's doubling in every 4 years. A 20% growth would go to $1.20, $1.44, $1.73, and then $2.07 of earnings by the 4th year. It's that compressing of time that really makes this growth phenomenal. And then finally, if you look at really ultra growth stocks, and I'm going to show you most of the stocks I'm looking at here have at least some history of growing at 30% or better. Now your money doubles by, really short of the third year. In other words, it takes less than 3 years to double your money. So compounding is such a very, very important factor when you're dealing with high growth. So let's go ahead and review now the FANG stocks: Facebook, Amazon, Netflix, and Google, commonly referred to as the FANG stocks. And I'm going to look at them several different ways. I'm going to look at valuing them several different ways. But let's start out, first of all, by looking at their historical growth rates. Okay, the 10-year earnings growth rate of Google has been 14.7%. It's actually, if I look at it for the last 15 years, it's been 22.8. So there's that 20% growth and that 15% growth, if you will. In the last 5 years, it's been growing at about 14.6%. Okay, now if I look at historical performance, annual performance kind of correlates with that growth. You can see that over the last 5 years, it's made investors 23% a year. Over the last 10 years, just under 21%, and over the last 15 years, about 17%. And that ties into these growth rates. Now, I'm going to go then next. I'll just do it in order of what I got here. Netflix 10-year earnings growth has been 30%. The 15-year growth has actually been higher at 36%. And the 5-year growth has been over 85%. And you can see the annualized rates of return have been, 42, and I'll use round numbers when I talk, 34 and 39%. Annualized rates of return that this stock has generated for its shareholders. Then, of course, the vaunted Amazon here has had 10-year earnings growth of 32%, 15-year earnings growth of 30%, and then 5-year growth of over 100%. And once again, we see these large, annualized performance. And by the way, I'm going to show that some of these companies, it really comes down to cash flow. When I'm looking at Amazon, it's really all about their cash flow growth rather than their earnings growth, which I don't have the historical cash flow on, or just for sake of time and convenience here. And then finally, Facebook grew earnings at 50% over the last 10 years. And of course, they don't have a 15-year growth rate. The company's not that old. And then the last 5 years, they've still been growing at 35%. Now, the Trendline forecast future growth is really phenomenal. It's 23% expected for Facebook, 28% for Amazon, 35% for Netflix, and 16.8% for Google. What's happening here is that, the bigger these companies get, let me go ahead and add market cap to this portfolio review here and make a point that when you're dealing with, with large companies here, you've got Alphabet at $1,375 billion. You've got Netflix at $224 billion. You've got Amazon at $1,542 billion. And then Facebook at $756 billion. So these are all very, very big companies. You can almost see a slight indication here, correlation, that the faster these companies are growing, the smaller they are. In other words, the bigger they get, the harder it is for them to grow fast. So now let's go through each of these 4 companies from a growth stock perspective and look at how can we know when to value those. And I'm going to also illustrate some ideas of how you really can't overpay for them. So let's start with Facebook, and I'm going to start with adjusted operating earnings here. Now, this is one that particularly I can use the earnings metric here because Facebook has grown earnings historically at over 33.15% a year, as you can see here in the dark green shaded area column here. They've grown earnings at 33.15%. And I want you to note how the stock price has tracked that. Now, I could have gone out here and paid a PE of 66 for Facebook back here. And, that would have been, well, actually, let me do a little differently. Let me go back here and find a spot here where I would have paid a PE of 36, which is pretty close to the growth rate. I'm using the P equals growth rate. This orange line is a price earnings ratio of 33, which is how I value growth stocks on my fast graph tool. I use Peter Lynch's PE ratio equal to earnings growth. So you notice the earnings growth is 33.15. The fair value PE that I'm drawing is 33. And you can use that then to evaluate whether that actually makes sense or not. In the case of Facebook, it does. You can see that, the price has really hovered around that 30 plus times earnings. When the price got cheap, now there was a time when the earnings dropped. We had a 15% drop in earnings in, fiscal year, which ends in December 2019, and we did see a period of time here where Facebook's stock price did languish. If I go from, April, I'm sorry, I had that already queued up. If I go from April, to the end of the year, Facebook in this case, only generated a relatively small rate of return. We didn't get a high rate of return on Facebook there. The point being is, though, if I look at the long-term performance of Facebook, $10,000 would have given me almost a 9-bagger, and there's where, you get the title of my article. That's significantly higher than the market, and keep in mind, this is one of the best periods of time in market history. However, if I bought it at 36 times earnings and held it through yesterday's close, I would have made 36% a year, which is, more consistent with what, I would expect to earn from this company. But the point I want to make is here you would have turned $10,000 in over $1 million in actually a shorter period of time because you would have bought it at a slightly better valuation. But having said that, I can't pay too much. I could not have paid too much to buy Facebook, even historically. I could have bought it at a PE, back here in February of 2014 at a 68 PE. We'll call it twice the growth rate. And if I held it through yesterday's close, I would have made 21%. Now, that's less than the growth rate of 33%. I want to make that clear. But I still made 21% a year, which is pretty hard to argue with. So one of the beauties of growth is that it can really bail you out. Now, let's look at valuing Facebook using some different metrics here, because a lot of people have told me or indicate they think operating cash flow is a better way to value these high growth stocks. So let's go ahead and look at Facebook based on operating cash flow. And to an extent, they're right. Now, the normal priced operating cash flow over this entire historical time frame has been about 26. But let me shorten this a little bit. The growth rate is 29.37%, and the normal priced operating cash flow is about 19. That's simply a calculation. I want you to not just look at that number or think about that number, but I want you to see how that number relates. We have a period of time where the cash flow is much higher, and then we have a period of time where the cash flow is much lower. But if I can buy this at a price to cash flow of under 19 or under 20, we'll call it, using round numbers, that's probably a pretty good value. And I can buy it at a priced operating cash flow today of 18.77 blended. That gives me an operating cash flow yield of 5%, which is actually pretty good for a growth stock, because keep in mind, I'm buying the future here. So when I go into forecasting here, I'm using my custom calculator. I've combined my near-term estimates, which would be this graph here, okay, with the Trendline 3 to 5 year growth estimate here. I've combined those two, and I get a company that's expected to grow at over 23% a year. This is operating cash flow now. And that would mean if I kept it around that 18 multiple I talked about, I've got a stock that could still generate me over 20% rates of return over the next 3 to 5 years or so. That's over a 200% total rate of return annualized at 21.71. Now, another way I like to value these stocks, I like to look at price to sales. And with price to sales, you look at this a little bit differently. You can see that Facebook sales have grown like a weed here, from 12.47 million to 70.7 million. This is revenues. And the point I'm getting at is, it's billion, excuse me. The thing I'm getting at here, there was a time when, the price to sales was very, very high, but today you can buy this at under 10 times sales, 9.59 times sales. That would tell me that that's probably a pretty good valuation for Facebook, considering what it's historically traded at. So that's my F in FANG. Let's move on now and let's look at the vaunted Amazon. And what's interesting about Amazon, and I talked about this in previous videos I did on Amazon, Jeff Bezos, who's now, of course, as retired, or not retired, but he certainly left the day-to-day operations. He's serving as the chairman of the board, I believe. But anyway, historically, he said he wasn't really too worried about making profits. It was really about growing the business. So, when I look at Amazon from operating cash flow, pure cash flow, you can see that the company grew cash flow at just under 30% a year. I'm using that priced operating cash flow equal to the growth rate. So I'm drawing a valuation reference line here at a priced operating cash flow of 29.7. And you can see, you could have paid that at any time. Right here, I'm getting pretty close, just a little bit higher. Let me see if I can get it real close. There's 28 times operating cash flow, and if I'd have held it over this period of time, which I measured here was 2013 to current, I would have annualized at 36%. I would have turned 10,000 into 97,000. There's that 10 times, growth that I was talking about in the title of this video. So, you've got a stock here that's actually done it. Now, when I look at it going forward, when I look at forecasting here, the company is expected to continue to grow operating cash flow at over 28% a year. So, even if I look at normal multiples of operating cash flow, which has been about 25, I'll go ahead and, show you that. If I get down here to a 25 times normal operating cash flow, I'd still stand to make over 23% a year. Now, here's the risk. Here's the rub. These growth stocks create all this value and all this return by virtue of the fact that they grow so fast. Remember the compounding table I showed you at the beginning of this video and how you're compressing time. So you can even overpay for these stocks because, just look at it historically from a point of view. Operating cash flow in 2009 was $7.45 per share. This year, it's expected to be $130 per share. Last year, it was $76.42. That's 10 times what it was in 2009 in a decade. So, you can just see the power of compounding when you're looking at this. Now, when I look at Amazon from a price to sales point of view, once again, we're seeing that it's trading at a relatively low price to sales level relative to historical norms. So once again, the power of growth is phenomenal. And you don't look at these companies the same way you do a traditional, I'm going to look at, Johnson & Johnson or General Mills, or even some of the faster growing stocks like, Lockheed Martin or General Dynamics or 3M or any of those. These are different animals. These are pure growth stocks here. And I do want to make that real clear. So let me move on now and look at the next one here. And this is Netflix. Now, this one causes me some problems because number one is Netflix. And the real secret, and I don't own this stock and I haven't researched this, so I'm going to leave that up to you. First of all, the company's only BB+ rated. And I think the cash flow here is part of the story here where, when we go back and look, for example, at Amazon, it's AA- rated. So, you're looking at a relatively low credit rating. They have a little more debt. They've not actually generated any operating cash flow for several years. It's been negative. And, same with EBITDA. Now, as I look forward with this company, I'm looking at a potential growth of operating cash flow of about 35%. But now we are in a position where we're paying an extremely high, priced operating cash flow. We're paying about 89 times cash flow at a $506 price. Now, if I held this out here and the price to cash flow went to 35, that would still give me a, 8 or 9% rate of return. If I went up here and valued this at a 49 multiple, price to cash flow of 49, I could make 16%. The risk here would be what's going to happen in the middle when the numbers aren't expected to be that great, and the fact that we haven't had that great a number. Now, it hasn't to date affected the stock price very much. But now I want to do something interesting here. I want to take a look at this company from a standpoint of operating earnings, because what's happened here, and I can go into fun graphs and show you this, but I'm not going to. What's happened here is this company has invested quite a bit of capex, to try to get into this streaming business and so on and grow it. This is a movies and entertainment business. So from a standpoint of adjusted operating earnings growth, this company has actually generated, pretty good historical numbers. And the forecast is about 35%. So, and if I look at the normal multiple that this stock trades at, it's been 157. But I want to evaluate that by looking. It's had high multiples of earnings historically, but even the lowest would be 83. So if I'm looking at, this stock trading at a normal multiple going forward here, you still could make a lot of money. All I'm trying to point out here is I do think Netflix is going to continue to grow. I do think the risk is whether they can actually, produce this kind of growth and generate, this kind of profitability going forward. The company looks, it's expected to do that going forward. So it's one that I think carries the most risk just because their cash flows have been under a lot of pressure lately, but a lot of that has to do with what they've had to invest in to grow their business and what they're facing. And they're facing a lot of competition. I don't think this particular company has the moat that the other does, that some of the others does. Now, if I go to a company like Morningstar, just to, add some more color here to Netflix, and I look at it, and I look at how these analysts are rating this company, they're rating it a lot differently than they are some of these others that I'm showing you here. You can see here that Morningstar only gives Netflix 1 star. Okay, that's the lowest that they give them. And they say their fair value is $250 a share. And of course, the stock is trading at over $500 a share. So, Morningstar also believes that there's some risk in Netflix. And I wanted to make that point that, what I'm trying to do, and they're saying, a 5-star price would be $125. That would be what they would consider to be the best price you could buy it at. A one-star price that they're saying now is only $437.50. So the real point of it is here that there is some issues with Netflix. Now, if they grow earnings like their forecast, I would think that, those numbers that Morningstar is throwing out are probably reasonable. And I still believe you can make money at Netflix. But I think you have to be careful with this particular one because it's certainly not the cheapest. And the biggest issue I have here, I want to be clear, is when I'm looking at these other metrics, such as operating cash flow, even free cash flow, which has also been negative, which I haven't showed you for sake of time. And then, of course, I'm going to go ahead and look at EBITDA here, or earnings before interest, taxes, depreciation, and amortization, and that's expected to drop precipitously. So there is some risk, certainly in the short run, with looking at Netflix today. When I look at it from a price to sales, it is trading at one of the lowest price to sales, not the lowest, but on the low side of a normal price to sales for the company. And then, of course, if I look at long-term performance for this stock, it's been just absolutely phenomenal. If I look at it from the standpoint of just, these last years, if I go all the way out here to the history of Netflix, going all the way back to 2002 and look at performance, it has been the absolute, 800-pound gorilla, if you will, of these FANG stocks. It's turned $10,000 into over almost $5 million, a 38% annualized rate of return. But it has done that with an enormous amount of growth. I do want to make that clear. So, the question is what's ahead of it, because the risk of these high growth stocks is how fast can they continue to grow. And this one has the lowest credit rating, amongst the highest debt of any of these FANG stocks. And again, it's right now struggling a little bit with cash flows. It's a warning is all I'm doing. And then finally, let's go ahead and look at Google. Now, the symbol is G, so there's the FANG, but it's called Alphabet now. But I'm looking at it now from a standpoint of operating cash flows, and I want you to see that this stock has correlated to about a 17 times, normal operating cash flow. That would indicate that the stock is moderately overvalued now. But again, with the growth stock, this does not mean that it's a bad investment, because this would still indicate a 9.5% annualized rate of return if it traded at, at these normal valuations, or even these high, maybe a 9% rate of return. When I look at forecasting going forward, the company is expected to grow operating cash flow at just under 17% a year. That would give me a 12% annualized rate of return. If I look at normal multiples for this company, which has been priced to cash flow of about 18, and I go here and I go up to a price to operating cash flow of about 18, I could make 13%. All I'm trying to point out here is that this company has grown at around 18% a year. It's now forecast to grow at about 17% a year. So there's still an awful lot of growth expected, at least, for operating cash flow in Alphabet. Now when I look at price to sales, just the other way I've looked at it, again, this is trading at one of its lowest price to sales. You can see revenue growth here has been, astounding over the last several years. Now, I'm also going to switch this, and I'm going to look at operating earnings here with this particular company, because one thing I'm trying to say here about valuation, now this company's AA plus rated, by the way, and only has 10% debt in contrast to Alphabet. Its long-term adjusted operating earnings growth rate has been just under, it's been just over 35%, 35.62%. So this orange line is a PE of 35.2. If I put the normal PE in, it comes in at around 31. But watch what happens as I shorten the time frame. And the bigger these companies get, now all of a sudden the historical growth rate's only been 16%, and I'm using a P equals growth rate of 16, which fit pretty well, but now we've got this more normal PE of 23, and then I drop it down to a 10-year growth, and I'm down to 15% growth, but that's stable. And then again, I look at forecasting earnings growth, and we're looking at about 17%, going forward on a 3 to 5 year trend line. So the point is, it's getting harder for Alphabet to continue to grow as fast as it historically once has. But anyway, this has been Chuck Carnevale talking about these FANG stocks and how to value them. The key is you can overpay to buy a high growth stock like this because of the power of compounding, just exactly, how fast these companies are growing. And this power of compounding, a good compounding table, really gives you insights into how powerful these companies are. This is all about the future. When you buy growth stocks, it's all about the future. You can overpay for them and make an awful lot of money by doing that, but the closer you get to trying to buy them at some rational valuation that is doable, that is achievable, and I've showed you, that if you buy these stocks at the growth rates of some of these metrics, you can do that. That lets you participate in the full measure of the company, and that's the key. How fast the company grows then will end up correlating very closely to how fast, your money grows as an investor in that company. Anyway, I hope you enjoyed this video on how to value growth stocks. They are a different animal. They are more risky because it's very hard to achieve the level of growth that these companies have done. But anyway, they're worth the risk because, they can make you a great deal of money. You can be a little reckless with them, but I would always suggest, as always, try to be careful. They don't call me Mr. Valuation for nothing. Hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to my YouTube channel. You might want to share this video with others because I think this is one that a lot of people really don't understand as well as they should. Thanks for watching. I'll talk to you again real soon.